The S&P 500 just dropped 1.5% to 7316. The VIX spiked 13% to 20.7. Gold held 4108. Bitcoin barely budged at 64,119. And oil slipped despite tankers still moving through active conflict zones in the Middle East. But the real story today isn't the indices. It's a consulting firm nobody talks about at dinner parties surging 40% in a single session. $170.37. Up 56% this week alone. Insiders are buying. Analysts are screaming buy. But the options market? The options market is screaming the exact opposite. A 3.77 put-call ratio. That's institutional money betting against the rally. Today we break down the divergence, the macro backdrop, and exactly what to watch for the next 5 sessions. Stay with me. Let's start with the tape. The S&P 500 closed at 7,316. That's a 1.52% decline on the session. In the context of a market that's been grinding higher for months, this feels like a pause. But the internals tell a different story. The VIX jumped 13.45% to 20.7. That's not a crash signal. That's a repricing of uncertainty. 20.7 on the VIX means the options market is pricing in roughly a 1.3% daily move for the S&P. Annualized, that's 20% realized volume the market is saying, we don't know what's next, and we're paying up for protection. Now, look at the calendar. The FOMC meeting was yesterday, July 29th. We're 1 day post-decision. The market is digesting. Higher rates equal higher discount rates equal lower equity valuations, especially for growth stocks. That's the textbook mechanism. But the S&P at 7316? That's not a market pricing in recession. That's a market pricing in a soft landing with sticky inflation. The Nasdaq, sitting around 25,000, held up better than the S&P on a relative basis. That tells you mega-cap tech is still the safety trade. Counterintuitive but true. The 10-year is hovering around 4.25%. The 2-year around 4%. The curve is still slightly inverted but flattening. The market has largely priced in the terminal rate. What it hasn't priced in is the duration of restrictive policy. The dot plot from yesterday's meeting showed a median expectation of 1 more cut this year, maybe 2. The market is pricing 3. That gap, that's where the volatility lives. Gold at 4108, up 0.27%. $4,108 an ounce. Let that sink in. Gold has doubled in roughly 3 years. Central bank buying, retail demand in China and India, and a structural hedge against fiscal dominance. Gold is telling you real rates are negative on a forward-looking basis, regardless of what the nominal 10-year says. Gold is the only asset that doesn't care about the Fed's dot plot. It cares about debt to GDP, and that number keeps climbing. Bitcoin at 64,119, up 0.34%. Barely a pulse. Bitcoin is acting like a risk asset, not a store of value. Correlation with the Nasdaq remains elevated. When the S&P sells, Bitcoin sells. When the S&P rips, Bitcoin rips. The decoupling narrative from 2024? Bitcoin is a high beta tech proxy right now. Until it breaks that correlation, treat it as such. West Texas Intermediate slipped to the low 70s. Despite tankers navigating the Red Sea, despite OPEC plus discipline, despite strategic petroleum reserve refill commitments from the White House. The demand side is the question mark. China's manufacturing PMI came in at 49.2. Contraction. Europe is stagnant. Driving season demand has been underwhelming. Oil is pricing in a global growth scare, not a supply shock. The macro picture, restrictive policy, sticky inflation, resilient labor market, deteriorating leading indicators. The S&P at 7316 is expensive at 22 times forward earnings if growth slows. It's fair if we get a productivity boom. The VIX at 20.7 is the market hedging the latter while fearing the former. Huron Consulting Group, up 40.37% today, up 56.03% this week. This is not a meme stock. This is not a biotech binary outcome. This is a management consulting firm with a 23 times PE, 11.8% year-over-year revenue growth, and a 4-for-4 earnings beat streak. Last quarter's surprise, 10.9%. Analyst consensus, strong buy. 90.9% buy ratings. 0 sells. That's as close to unanimous as Wall Street gets. So why the move? The earnings report dropped after the close yesterday. Revenue beat. Guidance raised. The company cited accelerating demand for healthcare and education consulting, two sectors that are non-cyclical, regulation-heavy, and drowning in complexity. Hospitals are consolidating. Universities are fighting enrollment cliffs. Both need operational turnaround expertise. That's Hearn's sweet spot. They also highlighted federal consulting strength. Government efficiency mandates are creating a pipeline of work that's visible for years. But here's where it gets weird. The put-call ratio is 3.77. That is heavily bearish. For every call bought, nearly 4 puts are bought. Institutional money is hedging or speculating on a reversal. This kind of put buying after a 40% move usually means one of two things. Either smart money is locking in gains via protective puts, or someone knows something the public doesn't. The insider data cuts the other way. MSBR score of 100. Strong buying. Corporate insiders are putting their own money in at these levels. That's a powerful signal. Insiders don't buy after a 40% pop unless they think the move is justified and sustainable. Peer comparison. The consulting space, Booz Allen, ICF International, FTI Consulting. None of them moved like this today. Booz Allen was flat. ICF up 2%. FTI up 1%. HURN is idiosyncratic. The move is company-specific, not sector-wide. That reinforces the earnings-driven thesis. What to watch next? First, options expiration flow. With that put-call ratio, gamma exposure is heavily negative. Dealers are short gamma. If the stock rips further, they have to buy to hedge. That creates a gamma squeeze potential. But if it sells, they sell. Volatility begets volatility. Second, the FOMC aftermath. Higher rates hurt consulting valuations through the discount rate mechanism. But Hearn's revenue is recurring and contract-based. The duration of cash flows is shorter than SaaS. That's a relative shield. Third, insider filings. Form 4 filings over the next 10 days will tell you if the buying continues. Fourth, short interest. Days to cover. If short interest was high going into earnings, today's move could be a short squeeze compounding the fundamental rally. The risk-reward. At 170, you're paying 23 times earnings for 11% grower with momentum. Not expensive, but the option skew suggests the market expects a mean reversion. If you're long, consider buying downside puts here. The implied volatility is elevated, but the skew is steep. You're paying for protection when everyone else is buying it. That's usually the wrong time. But with a 3.77 put-call ratio, the crowd is already positioned for a drop. Contrarian says, don't chase. Wait for the pullback to the 20-day moving average, roughly 135. That's your risk-defined entry. Manhattan Associates, $204.02. Up 21.32% today. Up 38.38% this week. This is supply chain software, warehouse management, transportation management, omni-channel commerce. The backbone of modern logistics. P/E 56.9. Revenue growth 7.4% year over year. 78.9% buy. 4 for 4 earnings beats. Last surprise, 3.4%. The move today, earnings after the close yesterday. Cloud revenue accelerated. Remaining performance obligations, RPO, jumped 22%. That's the forward revenue visibility metric. It tells you the pipeline is hardening. The company raised full-year guidance on both top and bottom lines. They cited retail and grocery customers upgrading legacy systems to handle unified commerce. Buy online, pick up in store. Ship from store. Real-time inventory visibility. That's Manhattan's moat. They own the warehouse. Everyone else rents space on top. Options market. Put-call ratio 0.33. That's bullish. Call dominance. Institutions are buying upside. This is the mirror image of HURN. At HURN, the options market is bearish after the move. At MAN, the options market is bullish into the move. Different positioning, different psychology. But, and this is a big but, insider sentiment, strong selling. MSBR minus 100. Corporate insiders are dumping shares. The CEO, the CFO, directors, they've been selling consistently into strength. That's a red flag you cannot ignore. Insiders sell for many reasons: diversification, tax planning, estate planning. But minus 100 is not a mixed signal. It's a uniform signal. They think the stock is fully valued or overvalued at 204. The supply chain software group, Blue Yonder Private, Kinaxis up 3%, Descartes Systems up 2%, SBS Commerce up 1%. Man is outperforming peers by a factor of 10 today. This is idiosyncratic. The earnings beat was well-executed quarter, but the magnitude suggests short covering. Short interest was 15% of float going into the print. That's high. A 21% gap up forces shorts to cover. That creates a feedback loop. The options market buying calls. Could be shorts hedging their cover. Could be momentum chasers. Hard to distinguish. Valuation: 57 times earnings for 7% growth. That's a PEG ratio of 8. You're paying a massive premium for predictability. Manhattan's revenue is 90% recurring. High retention. Net revenue retention over 120%. That justifies a premium. But 57 times? That's pricing imperfection. Any deceleration in cloud migration, any macro slowdown in retail capex, and this multiple compresses violently. The FOMC catalyst. Higher rates hurt high multiple growth stocks disproportionately. Manhattan is the definition of a high multiple growth stock. The discount rate impact on a 57 PE is severe. A 1% increase in the discount rate drops the DCF valuation by 15 to 20%. That's the macro overhang. What to watch? RPO growth trajectory to next quarter. If it decelerates from 22% to mid-teens, the multiple re-rates. Insider filing volume. If selling accelerates, that's confirmation. Short interest update mid-month. If shorts are gone, the squeeze fuel is spent. And the 20-day moving average at 180. A pullback there with volume would be a healthier entry than chasing a 21% gap. Let's connect the dots across asset classes. Gold at 4,108. Oil in the low 70s. The S&P at 7,316. The VIX at 20.7. What is the composite picture? Bitcoin and gold diverging. Gold making all-time highs. Bitcoin stuck in a range. This is the clearest signal in the cross-asset matrix. Gold is responding to fiscal dominance. Deficit is 7% of GDP at full employment. Debt service exceeds defense spending. The Fed's balance sheet is still bloated. Central banks are buying gold at a record pace. Over 1,000 tons annually for 3 straight years. Gold doesn't yield. It doesn't produce cash flow. It preserves purchasing power when fiat credibility erodes. 4,108 is not a bubble. It's a repricing of sovereign risk. Bitcoin, meanwhile, is correlated with the Nasdaq at 0.75 over the last 90 days. It's a risk-on asset. When liquidity is abundant, Bitcoin rips. When the Fed tightens, Bitcoin bleeds. The ETF flows have been positive, but decelerating. Retail participation is down from the 2024 peak. Institutions own the float now. They treat it like a high-beta tech stock. Until Bitcoin decouples from the Nasdaq and correlates negatively with the dollar, or positively with gold, it's not a macro hedge. It's a liquidity beta play. Oil in the low 70s with geopolitical risk premium embedded. Tankers in the Red Sea. Iran-Israel tension. Russian sanctions evasion. Venezuelan license uncertainty. And yet oil can't hold 80. China's oil imports dropped year over year in June. Gasoline demand is structurally declining. EVs, remote work efficiency. The IEA projects peak oil demand before 2030. OPEC Plus knows this. They're managing decline, not growth. The low 70s is the new equilibrium. It's disinflationary. Good for CPI. Bad for energy equities. The VIX at 20.7 with the S&P down 1.5%. That's a healthy fear response. The put-call ratio on the S&P is elevated. Skew is steep. The market is insured. When everyone is insured, the crash doesn't happen. The sell-off happens slowly. A grind lower. That's the base case. The dollar index at 104. Range-bound. The Fed is on hold. The ECB is cutting. The BOJ is hiking. The PBOC is easing. Divergent central bank policies keep the dollar in a box. That's stable for risk assets. But if the Fed surprises hawkish, or if the data forces a hike, the dollar rips and the S&P tests 7,000. The cross-asset verdict. Fiscal dominance benefits gold. Liquidity tightening hurts Bitcoin. Demand destruction caps oil. High valuations plus restrictive policy equals volatile sideways for the S&P. The VIX at 20.7 is fair value for this regime. Don't fight the tape, but don't ignore the gold signal. It's the only asset telling the unvarnished truth about sovereign balance sheets. Next 5 sessions, July 30 through August 6th. Here's the playbook. Session 1, today, July 30th. Post-FOMC digestion. Watch the S&P 7,300 level. That's the 50-day moving average. A close below opens the door to 7,200, the 20-day. If we hold 7,300, the uptrend is intact. Trade, sell S&P 7,400 call spreads. Collect premium. High VIX means rich volume, define risk. Max loss known. HURN, do not chase 170. The put-call ratio of 3.77 is a warning. Wait for a pullback to 135 to 140. That's the 20-day and the pre-earnings breakout level. If it holds there with volume, buy common stock. Hedge with January 150 puts. Cost basis protection. Target 185 by year-end. Stop 125. Man, the gap up to 204 is extended. Short interest was the